that's going to be crucial. But this is the start, which is in the green. Nifty Bank is about 0.5% higher as well. You've got 1,200 stocks which are higher, about 500 stocks which are lower. So that is the advanced decline ratio. IT index is up about 0.75%, 300 points higher on the Nifty IT index. You've got 7-8 names which are down, everything else is high. Easier to count what is in the green, at least as far as the starting point is concerned. That's a heat map, largely on the green side. Surbi.
Okay, when it comes to stocks, ONGC, the stock that we were just discussing on the back of the brokerage note, is doing really well. It's a Nifty winner now, 2.5% higher. BPCL is higher thanks to the value unlocking potential with the City Gas Distribution Company in Pune. Now, that's a joint venture, so let's look at the other joint venture partners as well. GAIL and IGL, which are the other entities that own the Maharashtra entity. They're all up to 1 to 1.5% on the higher side. By the way, Zomato has slipped. It's down about 4%, so taking full cognizance of what Jefferies is saying. Jefferies is concerned about competition, and that's why they've downgraded their estimates on Zomato. Anyway, on the Nifty, it's beyond some of these PSU names. Shriram Finance, Titan, Tata Consumer, HDFC Life, IndusInd Bank, Nestle. So you can see it's a pretty vibrant screen right now. It's cutting across sectors. Bajaj Finance and Finserv are doing well. Tech is doing pretty okay. HCL Tech, Tech Mahindra, these are stocks on the way up. The Bank Nifty is also holding higher. So let's just quickly throw up the big banks. Kotak is up about 0.5%. HDFC Bank is at the flat line, and this is the tricky part. Let's see which way these stocks go. SBI is doing much better, almost 1% higher on SBI. State Bank of India is up about 1% as well. So let's just wait to see what the larger banks do. But right now, it's a good-looking screen. M&M and Apollo Hospitals are really the only two stocks which are slightly negative. And by the way, Bajaj Auto is not really reacting too much. Remember, Parikshit has been reporting on the prospects of perhaps, maybe lower GST for CNG bikes, and we know that the Freedom 125 is a big product for Bajaj Auto. But right now, the stock's not latching onto that. It's down about 0.5%.
Well, a good start, actually. We are up close to 150 points on the Nifty. For the Nifty, the mark you're looking at is 23,900 or thereabouts. Nifty Bank, well, it's opened up with a gain of around 300 points, got slammed yesterday. The mark you're looking at on this one is 50,600. Both these two are the 200 DMA, and that's the reference points that we're looking at. Stocks that are moving around from the broader markets. ITI, in a world of its own, even yesterday the stock was buzzing around. Remember, float is limited, but that stock is up another 5% in today's trading session. Aegis Logistics, another one that moves quite well. It's been a big outperformer in the last few years. Even this morning, that's opened up with solid gains. A few more notable movers. Ashoka Buildcon. Big uptick is what we're seeing in in the initial moments of trade, and volumes as well rather large. So that stock's opened well. Kalyan Jewellers, Surbi's been telling us about how those numbers are quite good, and Mangalam as well. So both those stocks are doing quite well. The recent listings: Vishal Mega Mart, big volumes, opened up well in the green. Transrail Lighting, big volumes, opened up well in the green. And Invero Infra, all these three have opened up well in the green, and the volumes are quite large out there. What's not doing too well? Well, Utkarsh SFB, that stock is a little bit under pressure. I think, if I'm not mistaken, it was down close to around 5% in the initial tick itself. So that stock as well comes up for you on the screen. And Zomato, just take a look at that. Now it's down close to around 5%. Volumes very large out there. A couple of notable movers. So we had told you about Nuvoco. Remember, it's been a big underperformer, but they have acquired this Vardaj cement asset. I'll tell you what, logistically, it's a bit of a problem. The Gujarat market I've been tracking for the last 10 years or so. It's a very competitive market. But for the time being, the street says your capacity goes up by close to around 20%. You're getting exposure to new geography. So that stock is up close to around 2%. We'll try to get chatting with the management, maybe today as well, or tomorrow as well. So that's one stock that's opened up in the green. And KIOCL, market capitalization now 26,000 crores. Reports indicate it could get merged into NMDC. So if that report is true, then maybe those shareholders are quite excited. So KIOCL, volumes very low, but for the time being, the stock is up 2%. Need to note, yesterday as well, it was up close to around 5%. Float limited on this one as well. So keep that in mind. For sure.
All right, let's look at a few other names here. So, by the way, the Nifty is now 135 points in the green. We're about 23,751. So settling down comfortably with a 100-plus point gain on the Nifty with about 3.5 minutes in as far as today's market is concerned. It's some 6:1 advances to decline. Still early, but 6:1 in favor of advances at this point in time. So we pointed out Zomato. Swiggy is down about 1.5% as well. I think Naukri is down about 2.5%. that is also got very large volumes for this point in the day. There is Reliance Power, Ease My Trip, I think went up sharply yesterday. It's down about 1.5%. Metropolis down 1.7%, PVR Inox. But really, I mean, the Thyrocare is down a little bit. Thyrocare is down about 4.5%. But this is what is down. But it's a limited list, at least if you want to sort of look at price moves along with volumes. It's a limited list. Actually, it's a limited list with for stocks on the upside as well, if you want to add the volume bar as well. So I think we've already mentioned quite a few. I think AG's Logistics is one name. It's the second largest volume-led mover, 910 on AG's Logistics. So yesterday as well, so day before yesterday, last Friday, stock left off at about 810. It's up 100 rupees since then, between yesterday and this morning. The first few minutes, it's up 100 odd rupees on that one. Ola Electric is back at about 80 bucks, 3% in the green. EMBDL, I'm not sure, this is a name change but 6%, and it's got volumes, and that's why it's coming up on the list. That's EMBDL, 127 rupees on the price. India Mart is up about 4%. There's Oil India, ONGC. These upstream oil companies are looking good, and they're holding on. Goldium is up about 3%. K Fintech. So yeah, I mean, there's enough and more activity as far as single stocks go.
I just wanted to mention Utkarshan's, Nigel brought this up, Utkarsh Small Finance Bank. I think their Q3 update came in after market hours yesterday. And there, Abhishek points out that the collection efficiency has dipped. And a lot of these small finance banks and microfinance institutions, the market's watching out for any possible hints on asset quality very carefully. Their collection efficiency has dipped from about, I think, 92% to about 88%. Maybe that could be weighing on sentiment this morning.
Well, just one more thing. Yesterday, all medical experts were telling us that the virus is not something you should be worried about.
Yes.
But the markets thought differently, and we had all the diagnostic stocks that were zooming away. Today, it seems both are on the same page, the medical experts and the stock market experts as well. All those stocks have given up what they put on yesterday. You have Thyrocare, that was one of the big gainers yesterday. That's one of the big losers today. And Dr. Lal's, Metropolis, all of them a little bit softer. So,
on a lighter note, Nigel, when you put it like that, medical experts and stock market experts on the same page, that sounds scary.
No, the stock market has a different virus that it's dealing with. It's called the FBI exit virus. But more on that later.
Let's address that, right? And we have our market masters joining us now. Ashish Gupta, Chief Investment Officer at Axis AMC. We have Prashant Paroda, Portfolio Manager, Emerging Markets at Allspring Global Investments, joining in as well. Gentlemen, good morning. Great to have both of you here. So we've got, two strong, one local asset manager, and we've got a global asset manager as well. I want to put the blame at your doorstep, Prashant, on a lighter note, for all the selling. So let me start by asking you, when is this going to come to an end? As I was making this point in the morning, at the end of September quarter, FIs were already underweight relative to India's weight in the MSCI Asia ex-Japan benchmark. And they've sold about some $25 billion since. So this is some serious selling. FI weighting will be at a decadal low, if not more. So what's going on?
No, I think what's happening is obviously, India's valuations have gone up ahead of all other emerging markets. And some people think it's a good idea to kind of lock in some gains. However, I think this is a period of a very interesting time with Trump coming back and tariffs again being in picture. So overall, I think for emerging market funds, flows will be very muted till we get some clarity on the tariff picture. And I think the other big basket in EM is China, which, people still are a little bit worried about the real estate sector and how things will develop there, and also whether the government will do a big enough stimulus to counteract some of the consumption slowdown there. So I think overall the macro environment is a very cautious environment in the near term for EM investors.
Okay, all right. Got that. Ashish, just one other element, the local growth scare. Is there a bit of a growth scare? And is that impacting price action according to you? And how much of that is a factor? I mean, you're a veteran, and you're earlier after a veteran banking analyst as well, and that's a sector which shows us some of this stuff early on. So what are your thoughts on the growth side?
No, I think definitely, and I'll agree with Prashant that there is, of course, the global macro backdrop is not as strong, and really, to my mind, the trigger point of the big selling in for the institutions has been the fact that the U.S. yields have continued to go up, right? So U.S. 10-year yield is now up more than 80 basis points from where it was in the middle of the year. And that's really been, to my mind, a bigger driver of the FII outflows. Valuations in India have been expensive, and I don't think that really has changed materially for FII selling to happen. In fact, if you see the overall flows last year from FIIs, they have actually sold large caps, they have sold financials, which are the relatively cheaper sectors that are trading below their historic averages, and they have actually bought into mid caps, small caps. They're bought into the primary market, and we all know the multiples. Many of these new IPOs are coming in. The other factor, of course, more on fundamentals, is we have had muted earnings growth for the past 2 quarters. Earnings growth has come down to single digits. And in the last couple of days, we have seen the third quarter update coming from many companies, including the banks. And that is continues to be quite soft, right? So you have had some of the largest banks growing at 3, 4, 5% their loan book, compared to history where they were growing at close to 20%. So I think there is both this aspect of the macro not being as accommodative as it has been in the past few years, as well as the fact that we have some degree of slowdown that has come in.
Ashish, hi. Great to have you as well as Prashant with us this morning. So let's just complete that point, and then I want to come to the valuation picture, because you folks in your 2025 note also highlight that valuations are another headwind for this market. But first, let's complete the growth point. The market wants to believe, or at least the narrative so far has been, that this is transient. Second half, things will pick up. The government will come in, government will start spending, and, in general, a lot of corporates that we speak to, they're also saying that growth will pick up in the second half. Do you believe that?
So I think if we look at what has led to this slowdown, and we can probably, on a macro basis, look at 3 factors, right? So one, of course, is the slower government spending. That was particularly impactful in the first quarter because of the election. That is certainly changing, and we have seen over the last 2-3 months that pick up. The second was the monetary tightening that happened, and there we have had since August the RBI stance becoming more accommodative and neutral. But unfortunately, we have had this simultaneously exit of foreign money and pressure on the currency. And the central bank intervention in the forex market has meant that despite RBI becoming more neutral, we have not really had the liquidity coming back into surplus. So I think the 2 headwinds on the fiscal side, we clearly see that has turned more positive. On the monetary side, I think we still haven't seen that because despite the RBI change in stance, the actions on the forex market have meant that liquidity continues to be in deficit. The third, and probably is somewhat related to the monetary stance, is the negative credit impulse. So from a year ago, when loan growth was running at about 16-17%. Loan growth has come down to about 11%. So I think that is really the other crucial piece that we need to see changing for growth to come back. So we need loan growth to revive. We need liquidity conditions to again become more amenable. In addition to, of course, the fact that the fiscal spending is coming back.
No, so just to understand what you're saying, and it's very interesting we're having this conversation today because I think the first advance estimates of full year GDP, they're coming out at around 4:30 this evening. So we'll know the government stance on where we stand as well. But so Ashish, second half recovery in corporate earnings or no?
So I think compared to second quarter, there will be a recovery in earnings. But I think we will still not match the growth rates in earnings that we have seen over 22 and 23. So this year earnings growth will still be much lower than what we saw in the last 2 years.
All right. Hi, good morning, gentlemen. Good to see you in. Ashish, just want to drive home that point then with regard to earnings. The markets are down by close to around 10% or thereabouts from the peak. And we have seen that earnings pullbacks as well. EPS cuts have been to the tune of around 10%. So maybe some part of that earnings downgrade is mostly done. But do you think now there's a case where we see a PE, derating of the PE because we're giving it big multiples on the Nifty, 20, 22 times or thereabouts, because you're factoring in better earnings. Now, if the earnings don't come about, do you think that there'll be a case where you see the PE multiple as well getting derated?
So I think more than Nifty PE, I think where the PEs are vulnerable is more on the mid cap and the small cap space. So if you see small cap PE is still about 25 times, mid cap PE is still about 30 times. We have seen, actually very interestingly, in the last quarter, while the market has corrected by about 10%, surprisingly, mid-cap and small caps have actually continued to outperform. So I think the mid-cap and the small-cap index both are down only about by 6-7%. So typically, the market behavior you'll see is that mid-cap and small caps are higher beta. They will go up more than large caps and they will fall more than large caps. And that hasn't happened yet. I think one of the reasons is that market is still more optimistic on earnings here. We are seeing several parts where earnings have been more resilient. So whether you look at the capital goods sector, whether you look at real estate, travel-related sector, capital market beneficiaries, all of which are really more represented in the mid and small cap space, the earnings growth has not been bad. I think on the large cap, the earnings disappointment has been largest. For example, if you look at banks this quarter, they'll probably report 0 to 2% YOY growth only. Right. So I think we will have to probably become a bit more focused on stock picking, which are the companies where earnings are more resilient. And that is where you will see probably P's holding on. Other pocket, you definitely have a risk of P derating.
Okay, all right. Got that. Ashish, Prashant, coming across to you. We have been talking about this FI selling $10-11 billion odd, but as a percentage actually of the total market capitalization, it's not that much. So maybe that's another way of looking at it. But the hope is that this outflow stops. But Prashant, since we've seen a bit of a correction from the top, I think in the past you've spoken about private sector banks as something that you like, pharma is something that you like. So if you were to pick up two big themes for this year, what would they be?
I think some of the stuff that Ashish talked about, a lot of the growth of loan growth has come down a bit. So if you see some towards the end of the back half of the year, some sort of pickup in growth in banks and private sector banks. And I would say, again, you have to be very selective. There's some banks that are reporting, microfinance or other issues, and other banks not so much. So I think selectivity will be the key in terms of when it comes to asset quality and some of that loan growth coming back. I think domestic pharma continues to be okay in the near term. And I think IT services, depending on where rupee dollar ends up, and if we see some sort of discretionary demand coming back in US, IT services might do as okay as well.
Prashant, not an immediate sort of concern. Maybe it is. I don't know. So weighing on this, and this is not a sector or a sort of question on a particular sector, but the recent events, right? I mean, you must have noticed it, and you've been following what's happening with the incoming Trump presidency pretty closely. The recent attack, for example, on H-1B from the sort of this is Make America Great Again supporters. I mean, the right. Is that a how much should we read into it? Or you think it'll be this is all noise, and we've not seen attack on? I mean, we've seen this against the Chinese and paranoia about, but Indians have largely been kind of immune to all of this, at least in the US. How should we read into it? And yeah, go on.
Yeah, I think the H-1B issue, I think obviously, kind of Elon Musk kind of raised it, as kind of defending it. And I think Trump himself has said
Yes.
in the past that, he continues to see H-1B and support H-1B from his perspective. I think obviously there are pockets that within this coalition of Republicans, there are pockets that don't want H-1B, but there are other pockets that want H-1B. I think ultimately there'll be a balance, and I think the good news from the perspective is that what has really changed in this election is I would say the Silicon Valley has taken over politics in a big say. In the past, it had been more muted, but now it's come out in the forefront, and both from the Republicans and the Democrat side. So I think when it comes down to rulemaking, they're going to be very pragmatic and practical. And when it comes to H-1B issue.
Okay. Finally, Ashish, just to come back to, I asked this question to your peers at Franklin Templeton yesterday. We had them on a different show. I'm going to ask you the same question now. The resilience of the domestic investor, it's been tested for the first time since COVID, right? I mean, for the last 2-3 months, and the investor has been absolutely steadfast with those investments, the SIPs. Do you see that continuing? Because it's that wall of domestic money that has prevented a broader collapse. What are the insights you're picking up when you talk to people around you, your sales teams, etc.?
Well, I think we continue to see that part of the market being very steady. So actually, if you see a full year last year, domestic mutual fund inflows have been close to about 4 lakh crores. Total domestic institutions have put in about 5 lakh crores into the market. And actually, if anything, second half has been better than the inflow that came in the first half. So I don't think there is any volatility that we have seen. Of course, on the other side, in addition to the FIS selling, there has been a big wall of supply that has also come in, right? So if you look at all the IPOs, QIPs, secondary stake sales by private equity and promoters, that number also actually is about 5 lakh crores last year. So it's actually larger than the inflows into mutual funds. So I think we have seen that piece balancing out. For now, I think the domestic flows continue to be steady. But I think at the margin, it is the FI flows that is driving the market direction for the past couple of months.
Okay, all right. we leave it there. Ashish, it's a pleasure having you with us here. Thank you very much for your time. Prashant, appreciate your time here on CNBC TV18 as well. Good chat, gentlemen, and looking forward to many more in the days and weeks to come. Well, 170 points on the Nifty, so we're holding on nicely. 23,790 is where we're at. Actually, we're, if anything, on the Nifty, we're at the day's highest, not even an hour in, but for what it's worth, we are going nicely. 2,000 stocks are higher and about 350 stocks are lower at this point. MobiKwik has suddenly emerged as the biggest volume-led gainer. If you look at stocks, it was not there in the mix when we started. It's up 5% higher, 587 on MobiKwik, and that's coming through sharply. Aegis is at number 2 spot. Intellect Design is another one. It's up 9%. Again, not there in the mix, at least in the morning, but 9% pop, 981 on Intellect. So the composition of what's up on volumes has kind of changed a little bit at this point in time. And, you know, I remember on Friday, I was talking about this Apollo Microsystems, which has gone berserk. Once again, in the morning, it was not there. It's up 7%, 137, almost 140 bucks. So 100 to 140 very quickly in about, whatever, 2 weeks or so. And it's got humongous volumes once again this morning. So that's a bit more as far as individual stocks are concerned. We'll take a quick commercial break here. We're going to come back. The management of Happy Forgings will be with us as we discuss, the outlook and, of course, what they see out there in 2025. Stay tuned.
Welcome back. The markets are in a good space, so a good time to talk about happy things. And one such company that made a big announcement yesterday was Happy Forgings. It's approved a capital investment of up to 650 crores to expand the heavyweight forged and machined components. Mr. Ashish Garg, the managing director of the company, joins us on the show. Hi, Mr. Garg. First of all, Happy New Year and wishing you all the best for 2025. Y'all have started off with a bang. Big capex is what you've announced, particularly with regard to these machine components, and it's going to be heavier as well. So give us a few details. One is, what is the typical asset turn that you will get on this investment of around 650 crores? That would be what kind of revenue potential? And I understand that this could potentially be better margin, better return ratios as well. So in comparison to what you're currently doing, how much better can it be?
Happy New Year. Thanks. Yes, we have yesterday announced the capex of 650 crores through our board, and we are very excited for this investment. The move aligns well with our strategy to grow our business in the industrial sector. So this will help us in forging and machining components from 300 kg to 3 tons. So if you look at our history, we have always grown with enhancing our capabilities in terms of weight range. So this move will definitely help us in entering into different verticals like within industrials, like power gensets, which are used primarily as a backup for data centers, and it will also help us for marine application as well as railways and defense. So the typical asset turns on this project will be in a range of 1.2x. Depending upon what portion of material is sold as machined, and typically ROCEs will be better than our existing business, but the testing periods are a little longer than the current business. So it will take certain time, 2 to 3 years, to capitalize on the full utilization of the capacities.
Okay, so how much better can the ROCE be? If you could help us out with that. And also industrials, I think you could correct me on this number. It was around 3-4% of your total mix, which went up, I think, to around 12%. With this coming on stream, industrials as a percentage of your total mix, it goes to how much?
So industrials will, the way we see it, the industrials will look at around 25-30% going forward on full utilization basis of this capacity. We have already touched around 10-11%, and with this we expect to touch around 25-30% going forward. This will also help us in enhancing our export percentage and also accelerate our profit margins.
Exports are 20%, right, of the mix. So that moves up to what levels? So what is the desirable levels? And getting back to that point on margins and ROCE, how much better?
So in terms of, if I can say in terms of gross margin, yes, this will be around 10 to 12% better than the existing average today. And in terms of ROCEs, on full utilization basis, we can also look at upwards of 25%.
Okay. Let's also talk about the funding, Mr. Garg. I think it's a mix of internal accruals and debt as well. So if you could just update us, what is the cash level at hand? How much will it be through internal accruals? And again, the debt that you already have in the balance sheet and whether you'll be taking any additional for this.
So currently we are net cash. We have 250 crores of cash on the balance sheet. And for this investment, and we are looking at upwards of 300 crores of cash accruals going forward for next 2 to 3 years. So we won't be needing enough, debt for this. It will be majorly funded through our internal accruals. Besides this, we'll be having another capex of 350 crores on our existing line of business, which is also factored in. So in cumulatively, we are looking at over 1,000 crores of capex in next 3 years. And majority of it will be funded through our internal accruals.
Okay, let's talk about the overall outlook, because I think most on the street are expecting you to do a much better, much more solid second half. Are those expectations well placed? And also, how many years will it take for this new facility, the capex that you've just started now? When will it start contributing to the revenue? And once it's fully on stream, then how do we look at the revenue profile?
So we anticipate productions to start in Q4 of FY27 and beginning of FY28. And it will take 2 to 3 years to streamline the production on this capacity as testing periods are long. So you can say that, within 2 to 3 years, probably we will be running up the revenues from 600 to 800 crores on the new facility.
600 to 800 crores. 800 crores would be when the new facility is on full capacity. Now, just talking about the company's current revenues, I mean, your business as it stands now, what is the kind of improvement or recovery that you're expecting in the second half? Because the first half, the revenue growth has been a little muted, most on the street feel, as it's been, I think, in single digits.
Yes, you're right. So underlying industry is witnessing a slowdown, whether it is farm equipment or commercial vehicle sector. We have started seeing some green shoots on the farm equipment side. And it's a little early to comment on it because we have just seen December, and it was a mixed, season. So different OEMs have posted different numbers. Some has shown growth, whereas some has shown decline as well. So we need to see this quarter, particularly in terms of the deliveries they do at a retail level, to actually conclude if there are actually improvements in the market. On the CV side, the demand for multi-axle trucks is still low. And we are kind of getting a mixed feeling. We still need to see, couple of months to actually confirm that the market is doing well. But definitely market is not further slowing down, and we are at a reasonable level. When it comes to the export sector in a European market, yes, we have seen a sequential dip in last year, quarter-on-quarter degrowth in terms of farm equipment sector as well as commercial vehicle sector in European market. North American market also has seen a sharp slowdown, especially when it comes to farm equipment sector. But we see that, recovery, we are at a bottom right now. There is a lot of inventory action which has already happened. And we will be looking at some positive moves, but it will be too early to comment, on recovery.
Ashish, but for this year, what should we work with? Low single digit revenue growth for this year?
Yes, so we should be looking at, at a moment, we should be looking at kind of single digit growth.
And so 4-5% growth, revenue growth for the year?
Oh, I won't be able to comment for the entire year. For H1, it was a single-digit growth because we are trying to grow despite of commodity prices slowing down. So we have to see how the commodity prices will be in H2 for us. And also at the same time, we are working on certain new projects. So H2, it was around 6 or 7% growth despite of raw material prices falling. And H2, we have to see, what is the degrowth in the commodity prices. But we are on the new projects, and company's machining business, which is a crankshaft business, has seen 15% growth, which has us in improving our gross margin by almost 300 basis points in H1, which has helped us improving our EBITDA margin by almost 1.5%. So the EBITDA growth is over 15%, and we expect this to continue going forward as well.
Okay, so better margins will hold steady. On the top line, there's a bit of uncertainty. Final question before we let you go. You won a crankshaft order in the beginning of December from one of the domestic PVs. And PVs is something where you managed to make an entry point in the last 12 to around 18 months or thereabouts. Could you tell us, is this order win from an existing customer? Is it from a new customer? I think you had added Mahindra & Mahindra, in the recent past. So is it from a new client or is it from the existing one?
It's from the new client.
Okay, could you name it?
I'm sorry, I cannot name the client because of agreements, but definitely it's a new client.
But good to hear it's a new client as well. That means you're making inroads into the PV segment, which was just a very, very small part of your business. Thanks a lot for joining in, Ashish. Wishing you all the best for 2025.
All right, that's happy forgings, and we'll of course track the progression there. Look at the market though. There's a very sharp cut. Almost, I think, about not 100, but 80, 90 points sell-off from the day's high. And it all happened in the last 5 minutes, I think, because we looked at this as we went to Happy Forgings management for that chat. Market was cruising with about 160, 170 point gain. Just about 75 points left now. So this is happening right now. The Nifty is, it's very sharp. Look at the Nifty Bank as well, maybe. Take a look at what's happening there. Again, very, very sharp fall from 944. So this is about, 6-8 minutes old, this fall from the high. But it's come through very swiftly at this stage. Market breadth, it's kind of still holding. Some 1,800 stocks are higher, but declines have increased. Some 550, 600 stocks are now lower. So that is the overall picture at this point in time. We look at individual stocks, etc., on the Nifty and see what is going on. But it's time for our special quarter segment, where we look at earnings expectations from one sector every day, with the earnings season very, very imminent now. Rima is here to tell us what is the IT sector going to look like for the third quarter. Rima, over to you.
Thanks so much for that. So considering the seasonal weakness caused by furloughs in Q3, don't expect too much by way of growth. So we're looking at just about a 1% top-line growth for Infi, for TCS between 0 to 0.5%. For Wipro, it could be a negative growth. So numbers will not be much. The question is, can commentary and guidance support the outlook? There are only 3 companies where growth is expected to be robust. One of them is HCLTech amongst the large caps at a 4% top-line growth, but that's because the products business of HCLTech typically does well in Q3. But in the mid-cap space, it's Persistent and Coforge, where the street is anticipating roughly about a 4.5% top-line growth, and these two have been the rank outperformers in the IT services pack with about a 70 and 50% return last year. Now moving on to the guidance. Now expect Infi to raise their revenue guidance for this year. Now the current guidance is 3.75 to 4.5%. Most believe the analysts believe that the company will tighten the guidance and maybe raise it marginally. So Kotak is at 4.5 to 4.7%. Ambit goes up to 5%. But largely, as you can see, 4.5 to 5% appears to be the guidance for Infi this year. Margin guidance of 20 to 22% should remain unchanged. For HCLTech, the street believes the organic revenue guidance could get tightened. Currently, it's at 3.5%, but the lower end could be raised from 3.5% to about 4.5%, while the upper end will remain the same at 5%. The margin guidance for HCLTech 2 is likely to remain unchanged at 18 to 19%. For Wipro, the Q4 numbers, the guidance is seen at minus 0.5 to 1.5%. So what will the street be watching out for if it's not going to be so much about the numbers? Well, discretionary spend, has that come back? Recovery in stressed sectors like telecom, manufacturing, particularly on the auto side and in areas like Europe. Pickup in hiring. Is generative AI turning out to be a growth driver? Client budgets and even deal wins, which have been muted. Now, the Nifty IT sector, the index has given a 20% plus return for 2 consecutive years. And last year, there was a 13% outperformance for Nifty IT versus the Nifty. The Nifty IT gave you a return of 22-23% last year. Stocks started rallying last year, towards the end of last year in the second half, as growth showed signs of bottoming out and management started turning constructive on sectors like BFSI. And many stocks rallied despite a cut in the EPS. For some companies like Tech Mahindra and LTIMindtree, there was a double-digit cut in their EPS estimates, but yet the stocks gave a solid return. Just to give you one example, so for instance, something like a Wipro rallied close to about 27% last year. Again, all tilted in the second half. There were EPS downgrades, but many believe that perhaps now the run-up has become excessive. CLSA downgraded the stock recently. Citi introduced a 90-day negative watch list on the stock. So now as we enter calendar year 2025 in Q3, what we need to remember is the starting point for IT is different compared to what we had last year. Stocks have outperformed and valuations are richer. Morgan Stanley says, unlike the start of 2024, where the sector positioning was light, investors are now overweight the IT sector. IT outperformance from here on would require positive revenue and earnings revision, which according to them appears to be less given the current macro environment. So they remain selective on the sector with a view to book profits if the stocks show outperformance in Q1 calendar year 25. Their order of preference is LTIMindtree, Infi, TCS within the large caps and Coforge within the mid caps. Jefferies, on the other hand, believes that improving growth outlook will support premium valuations. They do acknowledge the Nifty IT is trading at 1 standard deviation above its historical PE levels, both in absolute and relative terms, and the valuations are rich. However, an improving growth outlook for the sector, coupled with recent earnings cuts in other domestic sectors, should support the current valuations of IT. So they prefer stocks where you are seeing strong growth visibility, and their top picks include Infi, TCS, LTIMindtree amongst the large caps, Coforge, Sagility, and emphasis in the mid-cap pack. Back to you.
All right, Rima, thank you so much for that very, very helpful and very comprehensive wrap-up. It really tells us that it's not just earnings in isolation. We need to look at so much more in terms of market positioning, valuations, and perhaps the big question is whether IT stocks are already priced to perfection and whether there is no room for error. In fact, let's ask exactly this to Apurva Prasad, who looks at the IT space very, very closely and has been doing that for so many years. Of course, he's from HDFC Securities. Apurva, thanks for joining in. So I'm going to start right there. I mean, Rima's nicely reminded us that stocks kept rising even when, EPS downgrades were happening all through last year, at least last calendar year. But different factors were at play. The market was stalling. People wanted to look for safe havens, and IT provided that. What happens now? Do you think companies will be able to deliver on these expectations?
Yes, good morning. Thanks for having me first. Yes, I think to an extent, a lot of positives have got priced in. But if you look at the growth trajectory, that's certainly looking upwards. So CY25 or FY26 is expected to certainly be a better year as compared to the previous year. In fact, if you look at the profit growth last 2 years, it's a very clear acceleration that is expected there. We're sort of midway through that, even if you look at where growth stands. I think what does not change is the nature of growth is it's going to remain very divergent. So you're going to have, even for this particular quarter, the gap between the fastest growing tier 1 and the slowest is between -1 to +5% on a YOY basis. That's much larger for a mid-tier IT company. That's as wide as -1 to +20%. So it's going to remain divergent, yet on an aggregate basis, it is looking up, and we're probably halfway to normalized level of growth that is expected.
Companies like Persistent, Coforge, this is where you're expecting better growth. Apurva, good morning. But again, I mean, as Rima pointed out, it's always the case, right? A little bit of rally, valuations get very, very full and very, very rich. By the way, the listing is also there. Indofarm Equipment, stocks starting about 22-24% on top of the issue price, 265. So it's a very good listing coming through for Indofarm Equipment, which is coming in at this point in time. Very, very strong, large volumes as well. So primary market, I mean, it was an absolute frenzy in terms of listings and IPOs towards the end of 2025, especially the first half of December. A couple of listings every day. I remember that one day at 5 listings, and I think the pipeline remains pretty strong as well. Let's see, of course, if the secondary market supports all of this action. But Apurva, go on about that point about these companies where growth is expected to be faster than your TCS, Infosys, etc. And is it actionable in that sense, or you think valuations are full?
So valuations certainly reflecting, because you look at the divergence in valuation, that's also reflecting the growth divergence. I mean, so you are looking at the set of stocks that are expected to grow faster are trading with much higher P multiples. A good way to sort of assess them is on a PEG basis and some sort of near-term growth trajectory, which still looks fairly promising. So I think within the mid-tier, persistent systems is expected to sort of lead growth within the mid-tier. That's something which has been our preferred pick for a while now. I think that's likely to continue. Within the tier ones, again, like I was saying earlier, it's going to be fairly divergent, but HCL Tech should probably lead, for the quarter. There is, of course, some seasonality factors driving that. But the nature of growth will remain fairly divergent in the next couple of quarters. So one has to take a stock-specific.
So, Apurva, on large cap then, where do you think one can get the best combination of potential growth as well as some sort of, valuation sanity? As, Rima was pointing out, I think one of the brokers also noted the point that many stocks are trading above the 5-year valuation averages. So, large cap, what would you like? What has the best growth prospects and also some valuation comfort?
I think from a valuation standpoint and certainly from a risk-reward standpoint, I think TCS is looking attractive. I think if you look at the rest of tier 1 versus TCS, I think the valuations are the closest that it's ever been. I think most of the risk seems to be priced into the numbers. So I would say there could be some upside risk if the company does back some mega deal. That's something which has been elusive for some time for the company. So I would say from the tier 1s, TCS for an absolute upside, and there is certainly valuation sanity in that respect to 5-year averages. So yeah, that's the one which we like.
Also, Apurva, a slightly broader question, not so much about Q3, but this whole, Gen AI piece. And the thing is that Indian companies, even the larger ones, they're not willing to divulge any specific numbers or give us any size, estimate of the size of work that they're perhaps looking at. While obviously they all acknowledge that they're looking at more Gen AI work and, more specific projects there. So from that perspective, which are the companies that you're watching for? Not just large caps, but maybe even some of the more niche companies. Which ones would you watch out for, say, over the next 4 quarters?
Yeah, that's interesting. So I think one way to sort of look at this is to look at the largest player globally who seems to be benefiting most currently. And they're almost 6% of their deals are Gen AI driven, 3% of their revenue is Gen AI driven, and more than half of their incremental growth is Gen AI driven. So if that's to be seen as a template, I think some of the larger IT names are perhaps at a stage where someone like an Accenture was a few quarters back. At the same time, some of the mid-tier IT companies that are in the product engineering services side, I think they do have a good chance to do well. Net beneficiary, because we've seen, I think, a lot of risk seems to be a lot lower around generative AI. We've seen very strong employee additions coming together with the fact that it's a net positive, both in terms of deals and growth. these seem to be certainly positives. And I would guess that some of the larger IT teams, as well as product development services, product engineering services companies, who have an advantage in this.
All right, Apurva, we'll leave it there. Thank you very much for joining us. And, we'll request you to have come back once we start to get some of these numbers out over the next couple of weeks or so. Kicks off, of course, with the big one, TCS, on the 9th, that is later this week. What else do we have? Markets coming off very, very sharply. So a clean 100, 110 points off the day's high on the Nifty. It'll come up on your screen. So we're left with just 40 points. Look at that. So the very strong start has been sold into, at least for now. But this is still, within the first 1 hour of trading activity. We'll take a quick commercial break here. We'll come back with, of course, Manisha. She'll put the focus again on commodities on the other side. And of course, we'll revisit some of these, big movers as far as specific stocks go. Stay tuned.
Okay, it's the same story playing out in the equity market. We are cooling off from the highs, but for the time being, yeah, there you go. That's the picture on the Nifty, just about 50 points up now. But for the time being, let's take stock of what's happening in the commodity markets as well. Manisha is joining in. Manisha, what's catching your attention at this hour?
Well, energy markets clearly, because the major moves seem to be coming in here as well for 2025 at least. Remember, the crude oil prices fell for straight 2 years in 23 and 24, but 2025 has started on a positive note. And even as we have seen prices slipping from its 3-month highs, remember, we did see prices gain up by 4.5% in the previous week. We did see 3-month highs last evening in New York session, where the crude oil prices hit $77 a barrel. But from there, we've seen a bit of a decline coming in. And the reason is the weak economic data that the streets saw yesterday coming in from US and from Germany as well. That has weighed on. And then there have been various reports putting out concerns that you could be looking at oversupply from non-OPEC countries in 2025 and demand may not catch up. And then there has been a Goldman Sachs report suggesting that the Iran oil production and exports could decline in the second quarter once Trump takes office, and there could be more sanctions on Iran. Is the reason you have 76 still holding when it comes to the Brent prices. Also supporting prices is the fact that Saudi Arabia yesterday came out with a advisory saying that they will raise prices for Asian consumers from the month of Feb. So that tells you that the demand perhaps is going to go higher as we get into the new month. The street as of now is watching out for policies from incoming Trump administration. And until then, you are looking at volatile prices. But having said that, the start to 2025 has been on the positive side. So even as you saw the Brent prices decline by 3% in 2024, they are trading 4.5% higher right now in 2025. And then it's all about natural gas prices. I mean, this clearly has been the hero in the previous year as well. We saw prices gain up by 63% in 2024 for natural gas prices. And then overnight, we've seen 10% of gains come in for prices yet again. This is because there is forecast of colder weather in the Western world. There are reports that US could see the coldest January since 2011. So the crude and the product demand is expected on the higher side. Well, there also is export demand on the stronger side. Also, when you look at the US LNG plants, they are looking at more export coming into the market, and that has been supportive for prices. All of these markets, though, will watch out for dollar index, where we've seen prices decline from 109. And then it is going to be about the US jobs report that comes in on Friday. Until then, it's going to be volatile.
All right, Manisha, thank you very much for that. Well, ONGC is what we want to focus on. We sort of highlighted this in the morning as well. Let's put the spotlight back on it. Hormuz is here. Hormuz, morning.
Morning, Prashant, and a healthy gain for ONGC that is coming in today, and that is on the back of CLSA upgrading the stock to a high conviction outperform and a 360 rupee price target, which is implying a potential upside of around 42% from yesterday's closing levels. What it says is that this Eastern offshore, which is going to ramp up to peak production, and that will lift its domestic oil and gas output by a significant 10 to 20% by the end of the year, and that is a positive trigger for ONGC. And the removal of the windfall tax will also allow the company to earn more realizations compared to around $75 a barrel in case the crude oil prices recover, which they are currently. And what CLSA is also saying is that ONGC is trading currently at a material discount not only to its own historic valuations but the historic valuations of its peers as well. And apart from that, it is also offering a very attractive dividend yield of 6%. So this is what is driving CLSA's conviction on ONGC, and a high conviction outperform stock, expecting a 40% upside from current levels. The stock up and about today.
Okay, all right, got it. Hormuz, thanks very much for that. We need to take a quick break. On the other side, our special segment, It's the Economy. Lata will be in conversation with Suresh Ganpati of Macquarie Capital and put the spotlight on bank stocks.
It's not just the stock markets that have recovered. There's an excellent recovery in the currency markets as well. The rupee, and many of the market watchers smelt this in the morning, has seen a superb recovery of about 15 pies. Remember, the low that the rupee had touched was 85, 84 pies to buy a dollar. And now it is 85.68 pies. That's the kind of recovery, about 15 pies recovery from yesterday's lows that we have seen in the currency. And this is for the first time, it's a long unwinding, dollar long unwinding, partly prompted by the fact that the dollar index fell very sharply overnight. Remember, it was over 109 last week. Yesterday as well, it was about 108.9, now 108.2. So a fairly sharp fall in the dollar index. If you compare week on week, the renminbi also was one cause of worry on Monday. It had fallen beyond that 7.28, 7.29, which the PBOC was defending until last week. It fell on Friday. Monday as well was a day of watching whether the renminbi will fall further. It didn't. It has stabilized at 7.32, and all that has added a lot of vigor to the Indian rupee bulls, if you please, as well. The FII number was not at all as bad as was feared. Looking at the fall yesterday, people were expecting another 4,000 crore number. It turned out to be more a 2,500 crore number. So today it is, action positive. For the rupee bulls is a strong word, but they're clearly, the dollar bulls are a bit on the back foot and are winding up their long positions. It looks like the rupee will have a decent day today. That's the word from the dealers. But from rupee, let's straight away go to focus on the banking sector, because we've had so many of the pre-results announcements coming in. It's been a mixed bag. And we've got a person who looks at this very closely, an expert at this, Suresh Ganapathy, Managing Director and Head of Financial Services Research at Macquarie Capital. Good morning, Suresh. Thank you very much indeed for your time. As always, I'm going to start with the big boy, HDFC Bank. Will you rejoice that their deposits is better than the market? Or will you worry that, yes, loan growth is low, but this is quite low at barely 3 to 4%?
Yeah. Look, I think, of course, they have indulged in selling down some of the loans. And, the path here is to get down to 90% kind of an LDR ratio. And then you can start growing a bit more aggressively, right? Every bank in the system which has gone through a period of merger or various other issues, of course, HDFC Bank doesn't have an asset quality issue. You have seen them going through a consolidation phase, right, where they actually decline their loan book for that matter. HDFC Bank can't do that. But nevertheless, at least grow at a slower pace. And then later on, go on to a path of higher growth and higher profitability. I think we have to understand that this is a period of consolidation. It will continue for another 6 to 12 months before you can see the acceleration going forward. What is more important here is the deposit growth. Let's assume they end the year with the same 15-16% kind of a deposit growth, which means you're talking about a good 4Q. Ultimately, all these things, Lata, has to flow into margins. So if they can indeed improve their margins and an overall ROA, the outcome definitely is likely to be positive for the stock over the longer run.
Are you getting a feeling that the margin pressure is over for the banking sector in general? Or is there still dog-eat-dog competition for deposits and therefore margins will be under pressure?
Okay, so let me put it this way, that the deposit environment should get slightly better next year, because if you look at it, the RBI has cut CRR of 50 basis points. And if you assume a money multiplier of 5x, which is 1 upon reserve ratio, that's the way we calculate money multiplier, or M3 by M0, the number is 5 times, right? So a 50 basis point cut should actually give a 200 basis point improvement in deposit growth next year. So you're looking at more like a 13% kind of a deposit growth, which can support a 13-14% kind of a loan growth. Now, this is a good outcome, I would say, for next year. Of course, it would partially be offset by the rate cuts that we are looking at, about 50 basis points for next year. And that keeps the margins slightly under check. So I don't think margins will expand from current levels. More or less, it should be maintained around the current levels is what I would say, because there is an offsetting factor in terms of a cut in rates by the Reserve Bank of India. Yeah.
Okay. Well, let me go to some untrodden path. Kotak Bank, they've not yet given us their pre-quarter numbers, but that resignation of the CTO kind of was a bit of a jar. because they already have been pulled up by the Reserve Bank for credit card issuance and, they were stopped last time. So is this a big setback, or is it valuable enough? Has it fallen enough? And you know the pedigree of the bank, so does it become even better than an outperform? I think you upgraded it some time back.
Yeah, sure. No, look, Lata, I think let's put it this way, that would the resignation of CTO in any way affect RBI's decision-making process? The answer is no. So, so by the end of last year, I think the audit report might have gone to the Reserve Bank of India. The RBI would be mulling over it, and perhaps, I don't know, I'm just guessing, April, May, you should get some kind of clarity from RBI on the ban, right? I don't think the resignation of the CTO in any way affects that particular outcome. Obviously, there is going to be a little bit flux. They will have to find a new CTO. What is more important for the bank at this point in time is to resume the unsecured lending, the credit card launches, all that has been banned by the Reserve Bank of India, right? So till the time, unsecured lending through the digital route. So till that time, obviously, you're going to go through a period of flux or other relatively weaker numbers. Once you get the approval from the RBI, that's the major catalyst for the stock,
Okay.
I would say. Yeah.
Okay. So probably it's a good time to buy before that announcement comes. It is your outperform, right? The other bank I want to ask is IndusInd. Yes, it was a nasty jar when they announced their numbers last time, but they have since sold their MFI loans, a large part of it, to an ARC. How did you look at the pre-quarter announcements and your view?
Look, I think the stress is going to be there, Lata. I mean, MF5 stress is only going to further increase over the course of next, I would say, couple of quarters. And unlike most other segments, this segment, of course, gets affected even more when there is a credit pullback, right? So you're already going through a period of over-leveraging, which is now getting shown into the numbers. On top of that, you're also not likely to lend incremental credit, which can further result in a credit squeeze and eventually further degree of NPL. So we are going to go through a period of pain for all MFI players, and IndusInd Bank being the largest in the banking space. Would go through that. The current price adequately, in my opinion, factors that kind of a stress. Now, the problem here is till the time you see earnings recovery, which means you start seeing plateauing of MFI NPLs and then consequently reduction in credit cost, that at least, Lata, is a couple of quarters away. Point number one. The second thing, unfortunately, the way you look at for IndusInd Bank is we need clarity on the CEO tenure. We're very close to that, right? So March 24th or 23rd is the time when Suman's tenure ends, and we are on January 7th. So we should get an update from the Reserve Bank of India by the end of this month or early Feb, in case he needs to get a 3-year extension. And that's a very important factor also driving the stock performance in the near term.
That will be a real shot in the arm. If that kind of stability is assured by the Reserve Bank, but we have to wait and see. And take your point on MFI. Utkarsh, SFB, highest decline in collection efficiency in this quarter. I mean, 87.7 is a bit of a jar. So now how would you look at the small finance banks itself? Is there any pick for you there?
No, none. I mean, actually, we don't cover any of them. But having said that, really, the MFI portfolio stress is going to play out. I mean, Equitas would be having a lower MFI exposure, to that extent less affected compared to others. But even everybody gets affected, right? So for the time being, I think it is very essential to understand that till the time, interestingly, Lata, I was just speaking to a couple of investors. After a very long period of time in the banking sector, we are back to asset quality discussions, right?
Yes.
Yeah, I mean, so we're not talking about when the unsecured NPLs will peak out. So clearly, you have to differentiate who is going to see more stress, who's going to see less stress. Of course, the likes of HDFC, ICICI, and of course, some of the PSU banks would continue to see lower stress compared to others. And therefore, you stick with them than any of the other smaller finance banks, or for that matter, NBFCs who are a little bit more exposed to that.
Fair enough. Let me quickly pack in a couple of more questions. So, PSU banks, I was taken aback when I saw the PNB numbers. They were so good, the deposit growth. But other banks that followed were, extremely modest.
Yeah.
Anything in the pack?
Yeah, look, I think if you look at PSU as a pack, Lata, I mean, yes, PNB's this quarter deposit growth obviously has been pretty strong, as you know. But, that's also a base effect because previous quarters has not been that great, right? So if you look at, for example, over the course of last 12 to 18 months, or for that matter, 24 months, structurally, they have been losing market share when it comes to deposits. And that's my cause of worry, right? So if your system is growing at 11%, you've seen HDFC Bank and ICICI growing at 15%, and many of the other private sector banks having done very well. The PSUs are the ones which are losing market share. SBI itself is growing at 10-11%, or rather expected to go at that level. So these smaller ones are losing even more. So that's a cause of worry over the medium term. And I'm still waiting for the ECL guidelines. I mean, I do believe that we are more closer towards the ECL guidelines now than what we were last year. And these guys don't carry any kind of contingent buffer. I'm pretty sure that there was going to be a hit on the net worth across all the PSU banks when the ECL guidelines gets crystallized.
Okay. And quickly now on the NBFCs, with RBI in a pro-liquidity mode and possibly a couple of cuts, are NBFCs better placed than banks? Which ones?
Look, I have a bias towards slightly lower valuation NBFCs. Look, the way I look at it is that, Lata, you have to understand that this is going to be a limited rate cut cycle. So while rates went up from 4 to 6.5%, on the way down, it's going to be only 6.5 going down to 6. So to that extent, the benefits accruing to the NBFCs are also going to be limited because we're only looking at a 50 basis point rate cut. So it is not that we're going to see a massive expansion in margins because of a falling rate environment, considering the rate cuts itself is limited. On top of that, the RBI is continuously monitoring credit towards NBFCs, bank credit towards NBFCs. I don't think so. That's already gone down to single digits. Maybe there could be a slight pickup, but banks are 50% of the funding market for the NBFCs, and banks will continue to remain cautious. And on top of that, I think one thing which the market is missing, in my view, is that growth this cycle is definitely going to be lower compared to the growth seen in the earlier cycle. Because the kind of growth in unsecured space for the fintech NBFCs, for the normal NBFCs that we saw, is not going to happen in the next couple of years. So we are going to look at a slightly lower growth environment because of the unsecured loan growth being relatively weaker. If that indeed is the outcome, I would not prefer the high valuation NBFCs. I'll go for a lower valuation NBFC like an AB Capital, or for that matter, Shriram Finance, which fits the bill relatively better.
Okay, point taken. We don't have time for insurance, but you have only one buy there. SBI Life?
Yeah, I mean, we will have to relook at the entire sector recommendation. But let's put it this way, that Lata, I mean, the problem with that life insurance sector in particular is the fact that the people thought we are seeing the end of the regulations. That's not the case, right? We are going to see now more regulations coming on the the bank assurance. That's right, distribution agents now. Now we have only tied agency concept in case of insurance. What happens if they open the entire agency market for everyone? So it's going to be quite an ugly battle. I don't know whether the system is prepared for a massive overhaul of the distribution ecosystem, right? A lot of regulations are on the product and on the consumer front. Now the regulations are going to move to the distribution front, and distribution is the bread and butter for the life insurance space. So it's quite an unsettling environment for the life insurance space. So I would be relatively pretty cautious on them.
Okay, that's beautifully explained, wrapped up so nicely on how we should approach the ecosystem itself of insurance. Suresh Garbati, thank you very much for giving us a perspective on all the three pillars of the financial space. We will touch base after we get a couple of numbers. Thank you very much for joining us. Sure. And as we sign off, maybe Suresh is the good luck charm. We are seeing a fairly decent recovery after that heartbreaking fall we saw at 10 a.m. in the markets. There has been a bit of a recovery, especially in the mid-cap space, and the rupee, surprise, surprise, recovered all the way to 85.66. So that's a very smart recovery we are seeing on the currency that gives a bit of confidence even to equity investors. Wrap up on Bazaar on that high note. Chartbusters takes the action forward.